G'day expats, welcome to another episode of Expat Chat, episode 78 today, and as always, joined with my co-host, mentor, friend, work colleague, business partner, Brett Evans, who is the Managing Director for the Europe, Middle East and Africa region. Brett, how's the sandpit treating you today?
All good here, thanks. All good. Can't complain. Place is fuller than a state school. I know that's not a politically correct thing to say, but it's busy over here right now. It's something that they've done a good job, but we're paying the price. I mean, roads are full, car parks are full, everything's full. So and we're getting very close to breaching into the summer season. So temps are slightly lifting up, and we've got Easter break, Ramadan, all sorts of events coming up. So it's a busy time of year for this neck of the woods. And for those on the call and watching us today, I'm joined by the Managing Director for the Asia Pacific region, Mr. James Ridley. James likes long walks on the beach and reading novels and going to movies and fine dining. It sounds like that sort of thing, doesn't it? I just had to go with it.
I know. It sounds like my dating profile from years ago.
That's right.
Be careful, I won't tell Camille. Mate, I'm good. All good on this side. I mean, it's busy. Gold Coast is busy at the moment. Brisbane's busy. All sort of the major capitals are busy. It's interesting to see sort of locally amount of infrastructure that's sort of, building, that they're sort of connecting that tram line back on the Gold Coast at the moment. And tell you what, the traffic is just horrendous now. What used to take you 5 or 10 minutes now takes you 20 to 30 minutes. So it's scary.
That's that great case of government council. I mean, they approve all these developments, but then they don't increase the infrastructure. So the roads are still the same. Another 5,000 people living on the same road, and they wonder why there's bottlenecks.
Yeah, that's exactly right. So, but that's all right, mate. It's pretty good here back in Australia. Not much to report. Inflation's still hanging around. Interest rates are still going up.
Energy costs going up 24% in 1st of July. Is that right?
Gas prices. Yep, that's right.
Wow,
yep.
That's expensive.
And they reckon there could be shortfalls as well. So
really,
I don't want to say it's a surprise though. I don't reckon we're going to be that concerned. I think we'll soldier on like we always do. But mate, as always, we're waffling on because we love to waffle, don't we?
Kings of waffle. We are the kings of waffle.
Yeah. But I've got a good topic. I want to have a chat about it, and something that comes up routinely with clients. And it's mainly around tax implications of selling overseas assets, and mainly looking at whether you're selling before you come back to Australia or whether you're selling them after you return back to Australia. So, I mean, assets, there's a whole laundry list of that. But before we jump into it, I'm going to pass the ball back over to you. I'm going to hand you the keys for that disclaimer.
Yep, all the information should be treated in the same relevance as Dr. Seuss, in that it's informational and entertainment purposes only. Like Dr. Seuss, you wouldn't take his advice. Like us, don't take this as financial advice or personal advice. If you do need to get personal advice, sing out to us, guys.
That's it. Now, I mean, it's a really good topic. When an expat's time overseas is drawing to an end, they are faced with difficult decisions. Most expats, they'll accumulate some accounts, some financial assets, banks accounts, savings, pensions, maybe some direct shares, especially if they're in certain countries like the US as an example. Other assets, cars, personal items, collectibles, homes, properties. I think the list is sometimes nearly endless, to be honest. Crypto, but crypto, come on. But with that in mind, so many different assets. So when is the best time, and whether you're selling them, when is the best time to do that? Is it before you arrive back in Australia? Is it after? How's it treated from the ATO's aspect? That's what we want to deep dive a little bit into today.
And look, it's interesting. There's the Excel spreadsheet answer of what you should do. Then there's the emotional answer of what you should do. And it's a weighted average in terms of what decision-making process wins out at the end of the day. Some people like the idea of retaining a property or some sort of asset overseas for whatever reason, whether it's a brag factor or whether it's actually something that they'll use. It sounds cool. I've got my place in London, my place over here. And look, I remember we had a client who, virtually did that for the reason. I said, well, what's the strategy behind buying these different properties? It sounds cool. What's his answer? So
that's good.
Yeah. So anyway, he sold most of them because it became a nightmare trying to handle 7 properties in 7 countries. But To me, it is a good question because, we always talk about, some of the risks that expats face, certainly while being an expat and certainly on repatriations and other considerations as well. And one of the things we did talk about is to try and mitigate risk. You should accrue assets in the country you intend to return to or retire to, because that way, at that point of time, when it comes to moving back to Australia, all your assets there waiting for you. You're not going, fingers crossed the currency is going to be good, or fingers crossed the tax laws will be better. Tax laws never get better. Just as an FYI to everyone out there, it's always going to be same or worse. I don't think we've ever seen a situation get better before, but certainly prove me if I'm wrong. But to me, it's one of those emotional decisions about, some people have emotional ties to a country and they want to retain a house there because their little Johnny was born there, or they've lived there for 20 years, or there's all those sort of things as well too. So to me, like we do with this podcast, it's all about just helping people make informed decisions. And you can make the decision that is not financially correct, but as long as you're happy with it and you understand the consequences, that's the point of this episode.
That's right. I mean, and I guess there is a laundry list of assets, and as Brett said, accruing your wealth back in the home country. It makes that repatriation just so much smoother and cleaner as well. But it's never the case. We're always going to have those assets overseas, and we've got a client right now, they're looking at retiring and returning back to Australia from the US, purchase a main residence. But on the US side, they've got their main residence and an investment property. So right now they're going through the process of putting those properties up for sale, taking whatever sort of price they can get. And then the next step is, when's the best way to transfer those assets back? Should I hold off on selling those assets until I'm back in Australia? Should I be selling them whilst I'm still in the US and I haven't actually permanently, I suppose, returned back to Australia? That's sort of the real big grey area without getting nitty gritty. And it's those sort of areas where clients do come to us for advice on, obviously. And I guess it's all about how the ATO is going to treat certain things. So why don't we just touch on a few things regarding, that general laundry list? Let's look at cash as an example. Cash is an easy one. I mean, I think Brett and I would both agree that it's important that ideally, whilst you've been overseas for that period, you have been sending back cash regularly, routinely, monthly. One, your dollar cost averaging on the currency. Absolutely. If you've been a non-resident of Australia, remember the ATO doesn't get to tax you on your assets outside of Australia. If you've been transferring money back to Australia, cash, and maybe putting it in savings account, if it's earned some interest income on it, then you need to make sure that account back in Australia has you nominated as a non-resident. That way they're applying the relevant 10% withholding tax, and that matches and is, I guess, match fit to someone that is a non-resident. So it's not really frowned overly by, I suppose, the ATO, but we always get a little bit concerned when people are accumulating just these large cash slush funds back in Australia, not doing anything with them, not giving it an active purpose either. Even putting in a term deposit, that's an active purpose. It's a form of an investment.
There's an offset on the other side.
That's it. Yeah. So we always want to be mindful of that. So sending back cash routinely. And again, that's addressing that foreign currency risk.
Yeah, and I think that's the big one as well too. There's such an aversion to sending cash back to Australia because it could trigger residency and those sort of things. And I always have a bit of a giggle to myself when people are in a jurisdiction that has a very similar tax rate to Australia, and they go, I don't want to trigger residency. Well, yeah, not saying that it will, but even if it did, it's not the end of the world because you're sort of paying the same tax anyway if you live in a country that has a DTA. But, I had this, sort of conversation with a client the other day who has accumulated a large sum of cash overseas, and their aversion was transferring the money back to Australia because of FX conversion rates. And then obviously we went through the process of talking about currency brokers and FX brokers and how you get the best rate. But one of the things I said to him was, look, you're sort of almost kicking the can down the road when it comes to the FX. You have to pay some sort of exchange rate, in terms of margin. Wouldn't you rather transfer, sort of 500,000 back to Australia and then let that asset grow in Australian denominated currency? Therefore, that 500 turns into $1 million over the next 10 years, but there's no more FX. You're not doing the FX on the $1 million, you're doing it on the 500. Whereas if you keep it overseas and you turn the 500 to $1 million, and let's say the FX margin rate's 0.3%, you're paying 0.3 on $1 million instead of paying 0.3 on 500,000. So you can kick the can down the road in terms of, trying to avoid FX. You're going to have to pay at some point, whether you do it now or in 10 years' time when you return to Australia. At some point, you have to move those funds back to Australia. But as you say, there are tax implications that you do need to consider. One of the biggest ones is the fact that people don't realise you can pay capital gains tax on cash. So if you return to Australia, you still have a lump sum overseas, and within a reasonable amount of time, you haven't moved that back to Australia. The ATO goes, hey, you've had time to clean your house and mow your backyard and get things in order. You've obviously left that money overseas for investment reasons, because otherwise you would have transferred it by now. Therefore, if there's a currency gain in your favour, you'll pay capital gains tax.
That's right. And generally the rates that taxpayers have to use is usually the exchange rate that the ATO has published, the daily rates. So they're obviously just the weighted average or average of that day, but it can mean, the currency gain is technically a capital gains tax event, depending on how long you've held it over there for. So there's definitely a caveat around that. And I guess when looking up on the ATO website, it's essentially just taxation of foreign accounts, and it usually drills down to more amounts over 250,000. But there's some specific provisions around that with small businesses as well. I won't deep dive in that today. That's not necessary. But a really important one that you can be seen dealing in a foreign currency. I think a lot of the big hurdles that a lot of expats face, especially in the Middle East, actually, Brett, is that end of service benefit or gratuity that is accruing. And timing of when that gets paid out is actually a little bit frustrating, because often it's a month or two after. And usually the expat might have actually returned back to Australia by then. So they're receiving potentially a very large benefit when they're back in Australia, and it's a foreign currency. And, sometimes the ATO might likely want to treat that as foreign sourced income. And, if you are in the Middle East, there's not really a tax withholding on that. There's no foreign tax credit that the ATO is going to be able to use. So I guess seeking a professional tax advice on that, and sometimes even a private ruling, can obviously help take care of that concern. But I know a lot of expats have faced that issue in the last 5-10 years.
Yeah, and look, it's an education piece as well too, and it's an accrued benefit that you've accrued while working in a non-tax environment. The exception to that is certainly pilots or anyone who works for airlines that have a provident fund. That's a whole different beast, which we won't talk about today because that's another 20 minutes. But generally speaking, if it's an end of service benefit, it's an accrual of, like a 10% super guarantee thing over time, and you do need to just do a bit of investigations with that just to make sure that you don't have any unintended consequences.
Yeah, that's right. And I think if we move through, and I mean, end of service gratuity, it's like a pension. And I mean, we're talking about sort of pensions now to a degree. When we look at a lot of the pensions around the world, and, I'll harp on about APAC, Asia Pacific, and Americas, especially the Americas, you've got your 401ks, your IRAs, those sort of things. Some of those you can sometimes access between 55 and 59 and a half, which is early. You can technically access 401ks before 55. You just incur that penalty tax. But if you're withdrawing that when you're in Australia and pulling out a full lump sum, it's a taxable event by the ATO. And unfortunately, the tax rates aren't going to be too great on that kind of large lump sum. So you need to make sure you do a bit of research there and clarify what kind of tax you'll be in for, because the ATO doesn't acknowledge a lot of foreign pensions around the world as some form of foreign super fund. Technically speaking, it's mainly just the UK system that actually gets a run there. As long as super, which is often going to have to be a self-managed super fund, is a QROPS, Qualified Recognised Overseas Pension Scheme, in the eyes of the HMRC in the UK, that's the only scenario which would allow you to transfer a foreign pension into super directly, but you still need to abide by your contribution caps, which again does reduce your opportunities there. But other countries, central or a provident fund or a mandatory provident fund in some of the Asian countries, they're not treated as foreign pensions. Their definition criteria is very different. So that means if you're pulling them out and you're in Australia, you're an Australian tax resident, very likely that's going to be a taxable event. You need to plan ahead, know what you're in for there. So if you were withdrawing them prior to returning to Australia, depending on how they're taxed in that local country, you could actually be saving yourself thousands of dollars in tax because how it's locally treated, and you're still technically a non-resident of Australia. So that's where timing can be quite crucial.
Timing's everything. And it's funny how we talk about it's like a flight plan or a roadmap or whatever you want to call it. If you just reverse engineer it, so this is the day that we're returning to Australia, therefore I need to get this done, this needs to be done up to that point. It's actually quite easy to manage. It's when it's all done last minute and, you don't have a time machine, that's when things get a bit expensive.
Yeah, absolutely. Absolutely. And I mean, another sort of asset class is direct shares. So a large portion of my clients are in that category where they receive options, share options, or restricted share units, I should say, or stock units, which means from their employer they're given shares as part of their package, their compensation automatically, and they usually vest over 12 months or quarterly or 3 years, just depends. Now, often it's a case that if you've never done anything with those shares, you've just been accumulating a large share portfolio in a single holding. There's a few things that I don't like about that. Two, you're now overexposed to one single share. And we've seen how volatile share markets have been, especially in the last 3 years. So if a large, significant portion of your wealth is tied to a single holding, then you are riding the emotions of that business. Absolutely. So I guess the quick lesson there is diversify. Divest out of the one holding, spread across all your assets, including debt, including property. You need to consider diversification as part of the whole plan. But when you come back to Australia, if you're holding those shares still, well, depending on your situation there, technically speaking, you can continue to hold them. But when you return to Australia, just remember that day that you return permanently, that's when deemed acquisition kicks in. So that means anything further that you do with such a portfolio, well, that's now under the lens of the ATO. So that means you would have to report capital gains tax events. You would have to record any sales. You might have only held those shares for 3 weeks. Doesn't matter. You've got to record that transaction still. That's what you need to really figure out what you want to do prior to leaving that country. Oh, if I'm in a country where there isn't maybe too much capital gains tax in terms of the rates, maybe I'll look at cleaning this portfolio up and recalibrating and resetting just before I arrive back in Australia so I can resecure that long-term investment strategy. And I think that's where important tax planning comes in, looking at moving these assets into the right structure, which might be a discretionary trust. It might be a company. It might be within your super. That's where some exciting opportunities come up for a lot of expats.
And I think, it's amazing how it's like the analogy I use with clients in the UAE. When you're driving from Dubai to Abu Dhabi doing 140 k's an hour with cars around you, it's pretty full on. If you're looking at the front of the bonnet, so your sight is very short, everything happens very quickly, very fast, and you don't have a time to react or anticipate. If you're looking 200 meters down the road, as you're driving 140 kilometers an hour, it feels like you're doing 100 k's an hour. It doesn't feel fast. So it's the same thing with this sort of stuff. When you are, there's obviously the exception when people have to return suddenly, but most people are returning in an orderly fashion. You need to almost look out 6-12 months and just work your way backwards, because as you say, little things done well and correctly can make tens of thousands of dollars difference in your pocket at the end of the day. And as I've always said, that the dollars do count at the end of the day, and you need to really just map it out. And I'll do this this day, this and this day. You've talked quite a bit about the Singapore expat tax. That's a great one that people don't realise. And if you're not prepared for it, you get stung with a pretty big tax bill on departure out of Singapore, and people go, where'd that come from? Whereas if you know what's coming, you can arrange the cash, you can sell it on your assets, because obviously Singapore and other assets, there's no capital gains tax, so you can crystallize that. Whereas the last thing you want to be doing is crystallizing an asset in Australia, in Singapore, when you're in Australia, because suddenly it's susceptible to capital gains tax, and you're getting hit on both sides. So
that's right.
I think it's that sort of the old 5 Ps that I was always taught. Prior preparation prevents piss poor performance, and it is so true. It's just if you do it well and you map it out, it happens at the speed of paint drying. If you do it all in the last week, you're going to find a world of hurt.
That's it. And I mean, the last sort of one main asset is probably property, and that can be quite complex, property. And the main reason why I say that is, technically speaking, you can benefit from Australia's main residence exemption on a former main residence overseas, but the timing of that sale and what assets you have back in Australia are crucial in understanding whether you can actually leverage that kind of concession. So it's not a one size fits all, and that's why I don't want to deep dive into it too much, because I don't want anyone sort of making an assumption listening into today's podcast. But there is an opportunity there if you satisfy a few things to be able to make sure the sale of a former main residence overseas is a tax-free transaction in the eyes of the ATO, which can be very beneficial. If it's not, then, and you've done the relevant, I suppose, what if analysis with a professional, then it might be a case where you might need to sell that property prior to returning to Australia. So that's a really important one, because often we lock up a lot of our capital in property because it's expensive.
Yep.
Do some research in terms of what you can access. If you're not sure, engage a professional.
Yeah, and that's the thing. It's people don't realise that the MRE actually can work in reverse, but sometimes people, I don't know, we call it confirmation bias. They'll try and make it work for themselves, and in actual fact, they've misinterpreted how the rules work and stuff like that. And done correctly, we've done it for a number of clients, and it works really well. But you have to have your ducks in line and do everything correctly in order to avail of that opportunity, as they say over here. It's something we always talk about with clients is that making informed decisions with the right information, it works. Whereas don't just assume. Assume doesn't work in tax law. There's nothing in the tax regs that say if you assume this, it's correct. You always need to make sure that you've done everything correctly, because once again, especially with a PPR overseas, we could be talking about hundreds of thousands of dollars in tax. From the overseas side or this side in Australia.
Yeah.
So it really can flip and flop between the two. And
that's right.
Unfortunately, we have seen some pretty average scenarios play out because people have assumed.
Absolutely. And I mean, it's dangerous also what gets thrown around in a lot of your online forum groups. And I guess there's a lot of keyboard warriors, which you'll see, and you need to be careful of taking the advice from those kind of groups as well. It's not a case of who's right. It's more so a case of what's right. Go back, have a look at the legislation, or engage someone formally to get that written advice. Absolutely.
Yeah. And how does it differ to, say, an investment property overseas as opposed to a PPR?
Yeah, so in investment property, I mean, technically speaking, if you were going to hold on to that investment property for a few years, once you've bounced back to Australia, then the way that it operates in terms of how it's taxed, well, first off, if you sold it in 4 or 5 years' time, depending on the country, it's very likely you'll have to pay some local capital gains tax. That can't really be avoided. But based on how the Australia side taxes it, it's taxed on a pro rata basis. So remember, in the eyes of the ATO, you technically maybe only own that property for, say, 3 years, but you've actually owned it in total for 7 years. But again, with the pro rataing, it means that 3-year period is mainly accessible. Most accounts would probably encourage a market valuation on the overseas property when you come back. And then off the back of that, because in the eyes of the ATO, you've technically owned it for more than 12 months. That means you'll get to benefit from the 50% CGT discount concession on that period of gain or growth for that 3 years that you've owned it in the eyes of the ATO. So there can be obviously a bit of work in that one. And there's also toing and throwing on the type of deductions you can get. Like there's sort of standardized rates for depreciation and other things, because in certain countries you can claim things, in other countries you can't. And probably a good reflection of that is you look at the US. The US incentivizes home ownership by letting you claim the interest portion on your repayments within your individual tax return. Australia is actually kind of the opposite. We incentivize investment properties through that negative gearing strategy, which I'm not going to deep dive into, but it's we're very opposite to the US in that sense, which is, I thought, quite interesting.
It is. And yeah, I mean, just because you're in one jurisdiction doesn't mean it works the same way in the other. And quite often, just reviewing your assets before your return and looking at the net position, not the gross position, but the net position after tax, can make what was a great investment not so great on the repatriation side, because the ATO may take more of a pound of flesh than your local jurisdiction did previously. And suddenly, what was a good investment, it made sense on the Excel spreadsheet, doesn't make sense anymore. And that's where you need to apply that. And then, to me, it's the other thing as well of trying to be a landlord, when you're a 14, 15, 20-hour flight away from, from your asset and how you manage that. It's that non-financial side. I don't know, in our experience, we often find within 12 months, people are going, you know what, done. It's just too hard. It's too hard. Unless you've got family or friends or someone in the region that can sort of poke a head over the back fence to make sure everything's going well.
That's right.
But quite often, both agents and tenants will take the mickey out of you because they know you're overseas and they know you're not there, and you may not be giving the same service levels that you've had before when you're living in the country.
That's exactly right. They know you're not around the corner and just going to come and knock on the door and go, hello, how is my property going?
Exactly.
They take the piss a bit. Yeah, that's it. And I guess it's the same, as you said, on the reverse. You come back, you're living a foreign property overseas. Is there going to be even a language barrier, depending on sort of where you got that property? That can always present a bit of an issue. It's not as easy if you have to do maintenance works and those sort of things. If you build up good rapport and trust with obviously agents, that can be a really good scenario, then situation that plays out. But often it's a case, it just becomes a bit of a hole of expenses and can be a bit risky, unfortunately. So just, buyer beware, investor beware, I should say.
Mate, I think we've well and truly done the episode justice in just going through the key points. Obviously pensions, non-taxable assets, shares, and then taxable assets, Australian properties. So I think we leave it there. Just a bit of housekeeping, guys. As always, if you have any questions, there's a link down below where you can enter your questions. We'll also our Australian Expat Financial Forum Facebook group, link is down below. And then, give us some currency. Just a rating or review would mean the world of difference to us.
Yes, absolutely. Thanks, Brett. Appreciate your time. Thanks, guys, for tuning in to today's episode.
Thanks, guys. Look after yourselves.